Hello, everybody. This is Carlos Pierre from Kiva's Strategic Initiatives team. Um, Thank you very much for joining this call. Today we'll be discussing the Kiva, the missing middle, and how the crowd vetting program works and how it relates to Kiva's work. To first off start, we just want to provide a basic introduction to what Kiva is. And one thing that's really important to clarify is that Kiva is a website, primarily a website that focuses on crowdfunding. So unlike a foundation or an impact investment fund that provides many other auxiliary services like technical assistance and grants and mentorship and networking opportunities, Kiva is really just a website that helps connect lenders with borrowers. Now, the process is relatively straightforward. You go to the website, kiva.org, and you can find somewhere between 3,000 and 4,000 borrowers. You can lend to them, and you will eventually, hopefully, get repaid 97% of the time. And then you can repeat the process and make more loans or pull out the money and shop on Amazon or something. Kiva has been around for more than 10 years now. We are about to lend $1 billion, which is quite impressive when you think that the average loan size is only $400. Now, the Kiva is now expanding towards beyond traditional microfinance towards what we call the missing middle. And I want to spend some time clarifying what the missing middle is and why it's important, or why there's much potential for impact while addressing it. One thing you need to understand is SMEs, small and medium enterprises, account for the majority of workers globally. Now, in high-income countries, they provide about 60% of the jobs, but they only provide about 30% of the jobs in low-income countries. Now, in high-income countries, SMEs are generating half the GDP, but in low-income countries, it's less than 20%. So you can see in the graph that there's a hump in high-income countries for what is the SME sector. But in low-income countries, it's not there. Like the humps happen at the micro level where there's lots of tiny entrepreneurs, and when at the hump at the end where there's larger, well-established corporations. And that missing middle is the lack of SMEs in emerging markets. Now, there's an incredible financing opportunity here. The World Bank estimates that the financing gap for SMEs is about $2 trillion. It's a huge market. So you have to wonder why financial markets have failed to provide capital to SMEs. And the problem is actually pretty straightforward. There's no credit history. Companies have unclear accounting, and the auditing standards themselves are very difficult. So it's really hard for a bank to easily understand the finances of one of its corporate or SME borrowers. Second is the regulatory framework. The creditor rights are weaker than what you can find in industrialized nations. Collateral is very hard to enforce. Claims are not public, and the bankruptcy and insolvency regimes are also weak. Now, to top it all off, you have payment systems that are plagued with corruption. So it's really difficult to enforce contracts here. Then there's another element regarding how you are now doing smaller loans that you usually would do with your corporate. That means that it has higher operational costs. Now, these smaller borrowers also are riskier, and so they have higher default rates. And in combination, this means higher interest rates, which result in less SMEs being able to try to tap these financial opportunities that banks provide. But in general, traditional banks really do not care about the SME sector. They're uninterested in developing the risk management systems, the loan products, and the delivery channels to work in such a space where the returns are low. The opposite end of the spectrum is the MFIs that were designed for individuals and are very good at managing their credit risk through group loans or other developed tailor-made loan products. for individuals and not for companies that have much more complex business models. And hence the missing middle. Companies that are too big for microfinance, but too small for traditional banking. Now, if Kiva is thinking of working here, what is it bringing to the table that is different from what everybody is facing? And one of the things that we have is the ability to leverage and take advantage of all the due diligence and all the social networks and all the trust that is being built from foundations, accelerators, and impact investment funds. So all of these three currently work with social enterprises in emerging markets, and they do due diligence. They do get to meet the entrepreneurs. They do work with them on their spreadsheets, on their financials, and understanding their business model and helping them improve. But say for foundations, they usually run a competition, and there's only one winner, and then most of the people who participated or made it to the second cut don't make it all the way. Accelerators get to bet many enterprises, but too few of them are actually large enough for impact investors to take an interest in them. But they do get to know them very well. And impact investors, as they go about their year, they review, say, 100 applications or 100 potential enterprises, of which they shortlist probably around 10 or 20, and then they end up investing in maybe 2, 3, 4 companies in a year. So this all goes to show that the sector itself is actually generating a lot of knowledge of the social enterprises that exist. It's just that nobody can really tap into that existing network. And at Kiva, we have the benefit of being able to approach foundations and accelerators and impact investors and be like, hey, would you like to put us in touch with the social enterprises that were too small for you to fund, the social enterprises that you thought were fantastic, but you weren't able to get investors for, or the ones that didn't win your competition, but you thought that they were great. In terms of the regulatory framework, Kiva has 10 years plus experience of working in 80 plus countries. And that has given us a sense of which countries are actually easier for Kiva's model to work in. And we feel much more comfortable than others in working in some jurisdictions. And for the crowdvetting program, we will actually be exploring about 25 jurisdictions, which Kiva feels sufficiently comfortable working in. And finally, the biggest competitive advantage is profitability. Kiva's crowdfunded capital allows us to really bring capital that is interested in social impact first. The Kiva loans are at 0%. The loans that are made, when the Kiva lenders come to Kiva, they lend at 0%. And it's with a 97% repayment rate, we're basically guaranteeing them that they're going to have a negative return on their investment. Now, I think that if you heard it's a negative return investment, it's a real downer. You're like, wait, that's the worst financial instrument I've heard of. But while that may be the case for Kiva, if you think of it as an investment instrument, if you think of it as a grant, it is a truly outperforming grant. It's a grant that you give once and you'll get it back, and you can give again and get it back. And with that 3% default rate, it's actually a very attractive, outperforming donation. But it's still not really a donation since you don't get your tax receipt. It's your money. You give it to Kiva. Kiva lends it to the borrower, and then once the borrower pays, we are able to give the money back to you, and then you can either re-lend on Kiva or again go to iTunes and buy something. So these advantages that Kiva has allowed us to develop two processes by which we work with social enterprises. One of them is through our field partners. So it's all these impact investors and all these accelerators that we work with that already have relationships with social enterprises. And we have vetted the way by which they select these social enterprises and gave them the ability, just like we do to our microfinance partners, to put those institutional borrowers on Kiva. The second model that we use is the Kiva direct to social enterprise. And that is lending to social enterprises, but without this intermediary. Now, what you have to remember is that the field partner played a key role in finding the entrepreneur, vetting the entrepreneur, preparing their profile for the entrepreneur, dispersing the loan from the entrepreneur, and collecting payments from the entrepreneur. And so in the DSE model, we're working off the assumption that it actually is possible for Kiva to replicate some of the work that is being done by our field partners.